the washout from the Treasury MNAVs, the Treasury Company MNAVs, was painful. I think that had to be kind of worked through. The quantum FUD had to be explored to some degree. I think that makes sense. The 4-year cycle had to be tested, kind of self-fulfilling prophecy. But I think, like I said before, I think the majority of the pain's behind us. And if I had to bet Bitcoin versus gold over the next 2 to 3 years, I would bet Bitcoin. Doesn't mean it's 100% likely to outperform. And I like to own both, and I have owned both, and I still own both. But, if I had to say, okay, gun to my head, if I had to say which one I think outperforms.
For most of the past year, Bitcoin investors have been stuck in one of the most frustrating market environments imaginable. Gold has surged to historic highs. Precious metals have been on a powerful run. Meanwhile, Bitcoin, the asset many expected to outperform everything, has spent months drifting sideways, weighed down by negative sentiment, regulatory noise, and constant doubts about the future of the crypto market. To many observers, this divergence looked like a warning sign. If gold was thriving in a world filled with geopolitical tension, rising debt, and growing distrust in fiat currencies, then why wasn't Bitcoin doing the same? According to macro strategist Lyn Alden, the answer lies less in Bitcoin's fundamentals and more in the broader macro cycle we are currently navigating. In her view, several temporary pressures, including liquidity shocks, structural market unwinds, and even waves of speculative fear around emerging technologies, have artificially suppressed Bitcoin's performance. But those pressures may now be fading, and if that's the case, the most important question for investors is no longer whether Bitcoin survives this phase, but whether it is about to enter the next stage of the cycle. In this interview, Alden breaks down the deeper forces shaping the global economy today: the long-term debt cycle, the rise of a multipolar world, the shifting role of reserve assets, and why the competition between gold and Bitcoin may be entering a completely new phase. Before we dive deeper into her analysis, make sure to like the video, subscribe to the channel, and turn on post notifications so you never miss our breakdowns of the biggest trends shaping the global economy and the crypto markets. These actions contribute immensely to the channel's growth. Thanks for your support and enjoy the video.
What do you make out of the bigger financial cycle that we're currently in? Are we in that end phase like Redalio has described?
I think we are, but I think it's an end phase of a 80-plus year cycle, and therefore the end phase itself lasts many, many years. I've described it that much of the developed world has entered fiscal dominance. So Japan entered it, the United States entered it, many countries in Europe and other developed countries have entered it. Not all, but many, to varying degrees. We've entered fiscal dominance, meaning that we've gone through a big private debt bubble. That has partially been delevered depending on the country we're talking about, but I'll stick to the US for now. And that's been kind of rotated onto the public sector. So we saw that happen in Japan, we saw that happen in the US, we saw that happen in certain other markets. Other ones are still kind of behind the curve on that, so they're still going to go through the process of rotating that more on the public sector. And that's a different macro environment. And it's generally a polarized environment. So I think that political polarization in the U.S. and Europe is going to be here, unfortunately, well into the 2030s, I think, along with as kind of countries deal with these debt issues. I think we're generally entering a more multipolar world, which is to say that instead of kind of the U.S.-centric or U.S.-dominant thing that's been in kind of structurally in place since World War II, I think it's not that the U.S. won't matter. It's just that the percentage of, say, its currency held in reserve, its currency used for trade, its share of global GDP, I think that is diminishing over time and becoming more multipolar. In some sense, I think that the century we were in, or the century and a half, was kind of the anomaly. Because if you go back in history, across the world, there are always kind of multiple powers. Like even in the height of the Roman Empire, the Han dynasty was also huge at the time. It's just that because of technology, they had very little contact. It was all indirect contact. There were these other, big empires or kingdoms out there that were of similar scale. China and India have always been a large percentage of global GDP. Yeah, obviously that term didn't exist back then, but a large share of global population, technology, just things that are being built. They've always been a big percentage. We went through this period where because of technological asymmetries. We went through this period of colonization. We went through this period of like literally the opium wars in China and just kind of like they call it their century of humiliation. It's kind of a very lopsided environment for a period of time, and I think that they're growing out of that and they're kind of reestablishing themselves in many ways as kind of the percentages they used to be before this weird era. And I think going forward, short of something like nuclear war or some sort of extreme events that can just change everything, I think we're entering a more multipolar world, which is directionally similar to what Ray Dalio talks about. I think he's historically quite a bull on China, and in some areas I'm a bull on China, but I think it also has pretty tight limits eventually. But I think basically a lot of the systems that have been built over the past several decades in this very unipolar world centered around the US, I think is shifting toward a more either bipolar world, so the US and China, or a multipolar world. We have the US, China, Europe, India, Brazil, these kind of bigger regional poles of power. And I think that's kind of the world we're going to live in and invest in for many, many decades going forward.
How do you see it evolve into a multipolar world where there are no fights or no let's say military wars taking place?
Oh, I think there's always going to be military wars taking place. I think that I guess the question is, how do you avoid like World War III, like fight between the major powers? I think hopefully the biggest factor is that mutually assured destruction aspect, which is that an all-out battle doesn't make economic sense against an adversary of similar strength, which is why we see things like the U.S. Our focus is on Venezuela and Iran and things like that they're not like a domestic threat in any sort of sense like that. It's all this kind of geopolitical chess playing and things like that. As far as China being in gold and Trump being crypto, I don't really view Trump as being crypto per se. I think he pivoted to that to get political donations. He saw that there's upside for being pro crypto. There's really no upside to being anti-crypto. Like Elizabeth Warren's anti-crypto army, there's no money there. There's no votes there. There's no one says, "Oh, I wasn't going to vote, but now that you're anti-crypto, I'll vote for you." No one, maybe like 8 people. So there's a big money there. They haven't talked about the strategic Bitcoin reserve. They haven't added to it. They just kind of ring fenced the Bitcoin they already had, some material degree. There's really no emphasis there. I mean, obviously from a personal standpoint, there's the meme coins, there's the DeFi, and I would classify a lot of those grift. But I don't think there's like a strategic Bitcoin focus here in the US or a strategic crypto focus in the US. I think that there's a strategy of just being more open to it than in China. I think over time in this more multipolar world, neutral reserve assets become more important. And this is something I'm talking about for years, and we've seen a huge run up in gold and silver and platinum. And I think if Bitcoin gets big enough, it can become one of those neutral reserve assets that sovereigns want to own. I think because of network effects and things I talked about before, and just kind of the path to penance of these things, they turn to what they already have. They turn to what's worked for centuries and millennia. They turn to what's big and liquid, gold. Tens of trillions of estimated gold market capitalization out there. So I think that's the incumbent kind of default winner in a more multipolar world. And then if Bitcoin becomes big enough and liquid enough and perceived as being stable enough, and some of these questions get answered around quantum and stuff like that, that's where it could also be a neutral reserve asset. So I think that instead of the US dollar and the US Treasury being at the center of everything, I think that in a more multipolar world, you have neutral reserve assets like gold kind of being at the center of everything. And then you have major currencies like the dollar and Chinese yuan being regional trade major currencies.
Across much of the developed world, governments have entered what economists call fiscal dominance, a stage where rising public debt begins to dictate monetary policy. Instead of central banks independently controlling inflation and financial stability, fiscal pressures from government spending start driving the system. In practical terms, this means governments must continue issuing debt and injecting liquidity simply to maintain economic stability. Over time, this process can weaken traditional reserve structures and accelerate the search for neutral assets that exist outside any single political system. At the same time, the geopolitical landscape itself is becoming more fragmented. The era of a single dominant superpower is slowly giving way to a world where multiple regional powers, including China, India, Europe, and emerging economies, are asserting greater influence over global trade, technology, and financial infrastructure. This transition does not happen overnight. In fact, Alden emphasizes that these cycles can unfold over decades. But as the system evolves, the assets that sit at the center of the global financial architecture may also change. Historically, that neutral reserve asset has been gold. It has thousands of years of trust, deep liquidity, and no counterparty risk. But for the first time in modern history, there is now a potential digital contender entering the conversation: Bitcoin. According to Alden, Bitcoin is still far too young to fully occupy that role today. Governments and institutions continue to treat it as a volatile risk asset rather than a core reserve holding. But if the network continues to mature, expand, and answer key technological questions over time, it could gradually begin competing for that position. In other words, the global financial system may be entering a period where neutral reserve assets become more important than ever, and the race between traditional hard money and digital hard money is only just beginning. Let's get back to Lyn Alden's interview.
So just because something becomes extreme doesn't mean it's wrong. For example, when Nvidia just, soared a few years ago, it became overbought on pretty much any, RSI metric you're looking at, but it stayed elevated because the fundamental reasons were real, that the whole world suddenly wants like 10x or more GPUs than it wanted before. And I think the same is true for these RAM stocks. A lot of them have just hit obscene levels of like technical overbought status, but I think they're reflecting a pretty persistent shift in our demand for RAM on a persistent basis. And I think the way I've described the precious metals bull run is that while I have been concerned around the sheer speed that they've moved and therefore their overbought status, like I used to be bullish on them in the sense that I viewed the downside as very low. Many of them, especially silver and platinum, but also to some extent gold, were pretty close to their mining costs. They were very underowned, and yet I view them as having a lot of upside potential. Now that they've had this big move, they're less asymmetric in the sense that I would not be surprised to see precious metals fall 50%, but I would not be surprised to see them grind higher either. They're just like the overall asymmetry is not there anymore. And I think that it's not that they've become a bubble or overvalued. I think that gold, silver, and platinum were undervalued. I think that they were underowned, undervalued compared to the advantages that they have. And the market kind of quickly right-sized them. So I think they went from undervalued to somewhere in the ballpark of fairly valued pretty quickly. So I view it as a locally overbought period, but that is pretty much backed by fundamentals. Like it makes sense for them to be at roughly these levels. As far as Bitcoin's concerned, I do think it's oversold. I think it's been kind of artificially lumped in with the software stocks more than it should have been, like we talked about before. So it's correlating with them oddly closely for no particular reason. I think the washout from the Treasury MNAVs, the Treasury company MNAVs, was painful. I think that had to be kind of worked through. The quantum FUD had to be explored to some degree. I think that makes sense. The 4-year cycle had to be tested, kind of self-fulfilling prophecy. But I think, like I said before, I think the majority of the pain's behind us. And if I had to bet Bitcoin versus gold over the next 2 to 3 years, I would bet Bitcoin. Doesn't mean it's 100% likely to outperform. And I like to own both, and I have owned both, and I still own both. But, if I had to say, okay, gun to my head, if I had to say which one I think outperforms, I would say Bitcoin, because I think that gold is somewhat euphoric at the moment. I wouldn't say it's a bubble, but it's somewhat euphoric. And I think that sentiment on Bitcoin is somewhat unfairly negative. Again, I try to be hesitant about reading into how absolute these things are. Gold and Bitcoin can go up together. They can go down together. Like they both sold off in March 2020 when we had a liquidity crisis. On average, gold is more risk off. It's an established, large liquid asset that's not changing anytime soon. It can be held without counterparty risk. Bitcoin is a 17-year-old asset. It's volatile. Until recently, institutions could barely own it. Now they around the margins they dabble in it. It's still widely held by individuals, many of which are just not known who they are. Um, there's questions around quantum, right? So it's perceived as a more risk-on asset. And then some governments are still opposed to it, so they don't like privacy or they don't like really big gains. So they say, okay, we're going to do like unrealized capital gain taxes on it, or we're going to imprison developers that make privacy, functionality that can be used with it. There still are these kind of technical, regulatory volatility, uncertainties around it. So on average, risk-off conditions will favor gold, and risk-on conditions, I think, will favor Bitcoin. We've seen AI has added a wrench to risk-on markets. So the really big mega caps that have been kind of the foundation of the U.S. stock market bull run, they used to be very capex light. They'd make a ton of money. They had network effects on their products. They'd plow their money into buybacks, which is really good for the share price. And now they're plowing it all into AI capex. So their free cash flow in many cases have gone sideways to down, or in like Oracle's case, dried up entirely. And that kind of makes investors spooked around their share prices. Then they sell off the software companies, which have also been kind of a leading contributor to the bull market. So you have these more risk-off conditions, which I think has favored precious metals. But I do think once the dust settles here, and we have another risk-on cycle, I think Bitcoin will be a beneficiary of it.
The top 3 charts or data points that you're looking at that navigate you through these volatile and crazy periods?
I think the number one thing is be familiar with the long-term debt cycle. So going back to what Dalio has done good work on this. My book Broken Money covers that pretty extensively. But that's a longer read than just an article or a set of charts. But I think being familiar with the long-term debt cycle, if people Google like long-term debt cycle Ray Dalio or even long-term debt cycle Lyn Alden, because I've written a lot about that because I viewed it super important. You can find articles and charts about it. I think another one is, just to understand Bitcoin, to put in 100 hours to understand how decentralized ledgers work. If someone hasn't, your audience has done this, but just if someone hasn't, I think understanding AI to a significant degree matters. Not in the sense that you're going to know how the code works, because ironically, even the developers don't know how the code works. It's black box in many cases. Obviously, some people know it more than others. But one thing is to kind of realize the constraints here. So like a human brain is still better than most computers out there in terms of like the number of calculations it can do. And it does that with the energy of a like 20-watt light bulb. So like less than a typical old school incandescent light bulb. It does all that. So it's an incredibly energy efficient machine. And then it has a self-healing robot attached to it, right? So we still don't have technology that mimics the human brain or the human body. Now, obviously, in some cases, we can do things better. Like a calculator is like 100 years old, a digital calculator, and it's better at a human mind at calculations, right? So we can certainly make tools that are optimized to do the things that the human brain's not optimized to do. It's very powerful. But again, they're not magic. So I think that taking time to understand kind of the physical constraints on energy, data centers, calculations per unit of energy, the inherent limitations that these things have, lets you kind of, I think, perceive them in directionally as rationally possible as way as possible, so that you can, one, see how productive they can be, but two, understand that they're not magic, that they do have constraints. And that there are energy, material, and other kind of inputs to these things that can be considered for investment purposes.
One of the most important distinctions Alden highlights is the difference between risk-off assets and risk-on assets. Gold has centuries of credibility. It is widely held by central banks, deeply liquid, and relatively stable compared to most financial instruments. In times of uncertainty, investors instinctively rotate toward it. Bitcoin, on the other hand, is still in its adolescence. Despite massive institutional progress over the past few years, it remains a volatile asset that many investors still treat like a high-growth technology bet rather than a global monetary network. That perception alone can dramatically influence price behavior. When markets enter defensive phases, periods where liquidity tightens, technology stocks weaken, or macro risks increase, capital often flows toward assets perceived as safe and established. That dynamic has played a major role in gold's recent surge while Bitcoin struggled to maintain momentum. But Alden believes this divergence may not last forever. In fact, she points out that Bitcoin's recent weakness may have less to do with its fundamentals and more to do with market mechanics. During risk-off periods, Bitcoin often gets lumped together with technology stocks and other speculative assets, causing it to move in tandem with sectors it fundamentally has little in common with. As those pressures unwind and the market eventually rotates back toward risk-on conditions, Bitcoin could once again become a major beneficiary of capital flows, and that's where Alden delivers her most striking conclusion. Despite gold's powerful rally and its deeply entrenched role in the global financial system, if she had to choose which asset is more likely to outperform over the next 2 to 3 years, her answer would be Bitcoin. Not because gold is in a bubble, but because sentiment around gold has become somewhat euphoric, while sentiment around Bitcoin has become unusually pessimistic. In markets, those emotional extremes often create opportunity. For investors trying to navigate these volatile cycles, Alden emphasizes the importance of understanding the bigger picture. That means studying the long-term debt cycle, recognizing the structural shifts reshaping the global economy, and developing a deeper understanding of emerging technologies like Bitcoin and artificial intelligence. Because while short-term price movements can be chaotic, the larger forces driving the financial system tend to unfold slowly, and those who understand them early are often the ones best positioned when the next major trend finally takes hold. But what do you think? Do you agree with Lyn Alden that Bitcoin could outperform gold over the next few years? Or do you believe precious metals will continue dominating this cycle? Let us know your thoughts in the comments below. If you enjoyed this breakdown, make sure to like the video, subscribe to the channel, and turn on post notifications so you never miss our deep dives into the forces shaping Bitcoin, global markets, and the future of money. And as always, thank you for watching.